All right, so going live here now on multiple platforms. We'll get started here very soon, but very glad to have Stephen Perno, Money or Debt, join me today on this Friday afternoon for me, evening your time, and morning for our American friends waking up. Stephen, thanks a lot for joining. How you doing?
Hey, my pleasure, and good to meet you now for the first time, and looking forward to it.
Yeah. I mean, we've had lots of chats in the past, and I think a couple calls or spaces with a bunch of other people from the Power Law crew
Mhm.
there. But it's great to chat with you one on one, and I'm looking forward to it. It's crazy days, Everybody's freaking out in Bitcoin land, even though we're um, still fairly close to the Power Law. But yeah, people are getting scared. I just got a comment: scary prices today. So yeah, in general, how are you feeling? How are you feeling about this market?
Well, I would like it to be higher. We all would, I suppose, but then it's also opportunity. And right now, it's really only down by half a standard deviation. So it's all
Exactly.
normal relative to the power law.
Yeah. Yeah. Been showing it a lot. I mean, almost every day now in my streams, I show the different. I go on percentiles over or under, but it's same deal. Not too far off the Power Law. So,
Mhm.
well, look, you have a wonderful slide deck already prepared, so I just want to put that up, and I'm gonna have lots of questions, but I think we should let you take it from here. I'm looking forward to this.
Okay, I'll put into play mode so that their slides are a little bit clearer. This is Isaac Newton. Many people know about Newton, about both gravity and calculus, but most do not know that he was master of the Royal Mint for 3 decades. So we'll
Yep.
talk a little bit about alchemy because Newton was also into alchemy.
Yep.
And one can argue that Bitcoin has now solved that problem. And we'll talk a bit about energy, but then we'll get into the power law and how power laws mathematically differ from exponentials. And in finance, what we usually see are, we usually talk about compound annual growth rate and returns and, discount and interest rates. Those are all exponential functions, right? And so a power law appearing for a financial asset is a very rare and really kind of a unique thing. And I'm going to frame this when Matthew asked me to come on, he kind of talked about the issue of, well, what happens is returns go down, and what about the inflation argument that people make, should we subtract for inflation and so forth. So I want to frame the first portion of this as Bitcoin measured in gold ounces, because gold has, very slow inflation, less than 2% in supply. So I'll talk about that. I'll talk about if you had a two asset portfolio with just Bitcoin and gold, how much would you put in Bitcoin and how much would you put into gold? And then I'll look at the power laws expressed in gold ounces for Bitcoin. I'll look at how the bubbles look. And then we'll switch back to the dollar, the US dollar, and fiat. And if we have time, we'll talk about the difference between cities versus companies. Bitcoin is more like a city, as compared to all the companies in the tech industry and other industries. I have a cosmological analogy with respect to ordinary matter, and dark energy. And then close with when could we possibly expect Bitcoin hyper, dominance relative to fiat, hyper Bitcoinization. Okay, so back to Newton for a moment. Calculus was something that he developed and Leibniz did independently around the same time in 1665, 1666. 20 years later, he published Newtonian dynamics in Principia, 1687. But he retired from Cambridge and he spent about as many years in London as master of the mint as he did in Cambridge in his career as a professor there. He took up that position in 1696, and he held it for nearly 3 decades, basically until his death. And he was also interested in alchemy in his later years, particularly at Cambridge. And there's a little bit of an analogy between alchemy and Bitcoin. So in alchemy, they have this idea of a raw substance of the world, that, some base metal, lead, or something, some base substance. And then they want to put it into a furnace, a crucible, and then use some sort of catalyst, which they called the Philosopher's Stone, in order to transmute it into gold. And at that time, the separation between alchemy and chemistry was not clear, because chemistry was still a developing science. And it was also tied into quest for immortality and eternal value. And I wrote an article about this recently and published it on Substack. And this is just a table that compares and contrasts a bit the analogy of Bitcoin. Here, the prime material is electricity, the crucible or the ASIC miners. The Philosopher's Stone is of course the algorithm, the Nakamoto consensus algorithm. And the transmutation is into Bitcoin itself, and it has eternal value, and it has the hard cap and the incorruptible ledger in terms of its eternal or quasi-eternal nature. Perhaps the first reference to energy as digital money comes from a Nobel Prize winner. Frederick Soddy won the Nobel in chemistry. And in 1921, he wrote a pamphlet, Wealth, Virtual Wealth, and Debt. He said that wealth originates from the transformation of energy, and he noted that debt grows exponentially, whereas real-world wealth has growth and decay, and he called for an energy currency. And people, I think, are more familiar with Henry Ford's call later in the 1920s, but also Buckminster Fuller around 1969. And of course, things took off starting from the 1980s with David Chaum and digital money, and 4 decades of not quite 4 decades, but over a quarter century of many people, contributing. And there was some of the science and cryptography that predated David Chaum's article. So the first big point to make about power laws is that they are not exponential. They are not compound annual growth, which is we typically see in finance. And power laws are found everywhere in nature. Every one of the 4 fundamental forces of nature are either pure power law or have a power law component. Both gravity and electromagnetism have 1 over r squared kinds of forces. And the 2 nuclear forces, the strong and weak force, have power law components and some other terms as well. This shows a few examples. The first one is the simplest kind of power law, which is linear. And this is the relationship between what's called the Schwarzschild radius, or the event horizon for a black hole, and its mass. It's strictly just proportional. The next one shows the time for the in-spiral of 2 black holes or 2 neutron stars, and we detect these when they merge, and they emit copious amounts of gravitational waves, but only in the very final second. And that's because this is a quadrupole effect, and so the in-spiral time goes as the 4th power of the separation. And so, as it gets cut in half, the distance, well, the time left is 1/16 as long as it previously had, right? And so it becomes a very rapid in-spiral. Then the wave intensity is much, much higher towards the very end. And that's when we detect them. The next one is about antimatter. It's the cross-section for decay. That shows the idea of an inverse power law to the first power in this case, although there's also another term that's a square term there. And the last one's the Higgs boson, and it shows that it's got really 2 power law components, one that's we call quadratic, which is going as a square, and another that goes as the 4th power. So a more steep power law, which is getting close to what we see in Bitcoin. this is another way of looking at everything in the universe. And this has a googol on each dimension, and a googol is 10 to the 100th power. And this is just mass and radius. So the x-axis is the radius measured in centimeters at the bottom, or if you want to use what astronomers like to use, megaparsecs up at the top. And then the mass, both in grams and in relative to the mass of the sun, solar masses. And you can kind of see two main lines here. One has a slope that's like a 45-degree slope, and that's labeled black holes. So everything up to the upper left is forbidden, or you've moved into the black hole domain there. Another is this kind of purple band, and that's the lowest densities that we find in the universe. We can measure the overall density. It's related to the square of the Hubble parameter, which is the expansion parameter. And then as we go to larger and larger scale, the largest things that we have are gravitationally bound or clusters of galaxies. We get up to superclusters, they aren't actually gravitationally bound, and then we have these voids. And so you see those in the very upper portion of this purple band, and up to the Hubble radius, which is the radius of the observable universe that we can see. So everything that's sort of galaxies, falls around that band. But then things that are of smaller scale, from stars all the way down to atoms, fall in this other band. And it's quite amazing that as you go from a COVID virus all the way up to the sun, you're pretty much in that same band. And the relationship there is a mass that's proportional to the cube of the size. And the size here is, the characteristic radius of the virus or the human or the sun. And so if you take mass divided by cube of the size, that's just the volume, and you have the average density of whatever it is you're looking at. And we see all the living things line up because they all have basically the density of water, right? Whether it's a virus or a human or a whale, where they're mostly water or something close to water. And even the sun is like water. It's 1.4 grams per cc, so it's only 40% denser than water, despite its large mass and high gravity. There's some other things there. It gets a bit too complicated, but it's just kind of interesting how ubiquitous these power laws are in nature. So we shouldn't be surprised when we see them. The next is a comparison of an exponential to a power law. And I showed on two different kinds of graphs, a log linear and a log log. Now you're much more used to looking at either linear plots or log linear plots where the y-axis is logarithmic. You often see that for financial series. And that's because they often behave, or typically behave, kind of exponentially with roughly constant compound annual growth. And this shows both the exponential in orange and the power law in blue. And you can see how much they differ. And the orders of magnitude are, quite many here. We've got 12 orders of magnitude on the y-axis. So the separation on the left side is, 5 orders of magnitude roughly between the two. So you can have a stretch where it appears like either the power law or the exponential is a pretty good fit, and they can have a tangent and they can have the same value. And in this case, it was done when the price was 63,000, and they can have the same compound annual growth in that neighborhood, right? Where the power law is relatively close to the exponential. But exponentials run away, and so they're less stable than power laws. Power laws can more easily persist for orders of magnitude. And we see this on the right-hand chart, which is a log-log chart, which means that it's logarithmic in the x-axis as well. And here we span 2 orders of magnitude, and it's running from 1 to 100. And I actually engineered that, so that's the power law that, is the power law for Bitcoin. And you can see it passes through many orders of magnitude on the y-axis, close to 6, when it passes through one order of magnitude on the x-axis. And you can very much see here that the exponential has a very different shape, that it grows much more slowly in early days, and then it's much steeper in late days.
What's the
And so
CAGR of that exponential? Do you remember?
that one, that's a good question. I think that's a very good question. I think it's roughly, I've forgotten.
It's intersecting
Yeah.
it's intersecting at a pretty close recent price, right?
Right. It was a price early in less
Yeah.
than a year ago.
So probably like 40 something percent.
It's about that, right? Because that would be right. Basically, a doubling in 2 years kind of a thing. So in that case, the difference here is that for exponentials, there's a characteristic time. And if you write it as an exponential, it's called an e-folding time. But you could convert that into a doubling time, which is 0.7 as long, as the e-folding time. And so if this is doubling in 2 years, the e-folding time would be about 3 years. And that would be the T0 characteristic in the function. The power law has no characteristic time scale. The only important thing about the power law is you have to identify time zero, and you have to use that as your starting point. So it's critical that you take January 3rd, 2009 as the starting point. That's the proper way to evaluate whether it's behaved as a power law. And it's very easy to demonstrate. You can do it in 5 minutes or 10 minutes, really, that the power law holds. I mean, I did this on my phone in a few minutes with ChatGPT. I just asked for the yearly lows. And so, with a dozen or 14 data points plotted or the yearly lows, you get a power law fit. This is a log linear graph. The slope is a little higher, but it's close to 6.3. And you can project that the low in 2030 would be around 300,000. And in 2035, the low price would be around 1 million. And this is showing a 1 standard deviation band around the curve and the projection. All right, let's look at some analysis versus gold. First, just by looking at the numbers and putting them in a spreadsheet, you can demonstrate that Bitcoin is a power law and gold is not. And this is just annual prices on the first of each year from 2011 up through 2025. And I plugged the November 15th value in as well. And you get the power law slope. For Bitcoin versus dollar, it's 5.84. You get it for gold, well, it'll give you a result. It's 0.29, but the difference is that the R squared is very low. So the fit is very good for Bitcoin. It's got an R squared of 0.96, and it's low for gold. It's 0.28. And really what you're seeing compound annual growth, 7.4% for gold, which gives a better fit. I don't know what the R squared was, but it's better. So you can take the ratio of Bitcoin to gold, and that ratio has gone in log 10 terms from minus 3.6 up to 1.4. We're now at 20 odd ounces, a little over 20 ounces. And you find that the power law slope is about 5.5. And the R squared is still quite high, 0.94. And this shows the same thing. Gave a slightly different answer. AI did the regression. I don't know why it's slightly different from the Excel spreadsheet, but close enough to illustrate the point. A 5.4 fit. So it doesn't take a lot of data. You see a couple of outlier points, which are the 2013 and 2017 bubble peaks, R squared 0.94. And this is from someone else from Econometrics talking about Bitcoin's correlations with NASDAQ and with gold. And with NASDAQ, the blue line shows that it's kind of, well, of late 0.5, sort of in the 0.3 to 0.5 range. And with gold, sometimes it's positive, sometimes it's negative, but it tends to be much lower. And right now it's about 0.1, the way they've looked at it. So there's much more correlation between Bitcoin and NASDAQ. They're both risk on kinds of assets, as we've learned, in the past few weeks, as opposed to gold, which is typically acts more like risk off. Here's my own measurement of Bitcoin versus gold correlation over the full time period. This is a time from 2011 on when Bitcoin increased by a factor of 100,000 in price or more, gold by less than a factor of 3. So that's a good chart to show to a gold bug. But the right-hand chart shows the rolling 52-week correlation of the log of Bitcoin versus the log of gold. And you can see that it varies widely and goes, positive up above 0.5 and, negative down to minus 0.75. So don't rely on it being stable at all. But in the last few years, it has been more stable. It's been up in that kind of 0.5 to 0.75 range. And you can also do a Granger causality test between Bitcoin and gold. And what you find is that gold leads Bitcoin, and it's anywhere from 2 to 12 or 13 weeks. Anything below that red dash line, which is that orange curve at the bottom, is a positive result for Granger causality, saying that gold prices lead Bitcoin prices. Okay, this is showing both the ordinary least squares and the quantile regression with a complete data set. This is actually a weekly data set. And in either regression, you get a power law index of 5.3 and a low uncertainty, only 0.02 standard error. In the slopes, this R squared 0.94. And we're very much below trend fair value, which would be right now 40 or 50 ounces in terms of gold. And currently, as a couple of days ago, we were under 23 ounces. So right now, given the latest drop, we're probably just over 20 ounces.
Yeah, mine's even higher. Mine's 60 ounces fair value. So it's quite low.
Yeah. Which form of regression did you, OLS or QR?
OLS.
OLS. Yeah. Yeah, that gives a higher. Yeah, 60. So I had been saying back in the spring that, we were not in a bubble with Bitcoin. We had a couple of things that looked like they might be bubbles, like late 2024. I said, we're going to need this to be confirmed in gold, and we're going to need 40 ounces, and we never got there. Okay, now let's look at the residuals. So here I've subtracted out using the ordinary least squares regression. I've subtracted out the power law. And so we're seeing here the residuals on the chart. We're seeing the residuals of Bitcoin measured in gold ounces in log 10 terms, right? So the log residuals. And then I've approximated the bubbles by setting a threshold at 0.15 in log 10 terms, and then requiring at least 3-day duration. And there are only 7 bubbles between 2011 and now. And, 3 of them are quite large in duration, and really only 4 of them are significant in their energy. And the energy is just the area under the curve. And I just measure the curve when it's above the threshold, right, for this, because it's not a bubble when it's below the threshold. And then you have some anti-bubbles. You had actually quite a few more, but they have a lot less energy on average. So what we find is that the sum of all the bubble energy was 248 in, residual days, and it's only a small fraction of that, 33 for the anti-bubbles. But in both cases, 2/3 of the energy is in the first half of this plot. So the bubbles have been decaying, right, in strength
Yeah.
and in duration. And we haven't had any upward bubbles, since the beginning of 2022.
Yep.
Now, Giovanni did a very detailed analysis and found out that Bitcoin in dollar terms adheres not to Gaussian. I've been able to model it as core and bubble as dual Gaussian. So you can do that, and that works well. Or you can measure, you can fit the entire distribution with a T location scale distribution. And I've applied this also to gold. So this is applying it to gold. And it fits quite well. And this location parameter, which is this mu sub 0, is basically the power law. And it comes out 5.48, just as you expect. But there's a lot of uncertainty because of the way this is done. You're looking at every weekly variation. And so you get these very broad tails in that. And yeah, I did it for both daily and weekly data. For weekly data, it was even more uncertain, but for daily data, it matched the power law value quite nicely. So this is a log linear plot, and it's showing, as that basically Bitcoin went from less than 1/1000th of an ounce to now around 20 ounces, and a bit higher on trend. It should be up around as high as 60. So we have some work to do, I guess. But it's quite a good fit, R squared 0.94. And this 5.4 trajectory is such that if the age of Bitcoin increases by a factor of 2, then the measure in gold ounces should increase a factor of 42. And that projects a good delivery bar of 400 ounces around 2033. And if you have a good delivery bar times 20 million, then you would have the equivalent of 8 billion ounces, and you would exceed all the gold on Earth, which is closer to 6 billion. And Bitcoin's market cap would exceed that of all gold above ground. These are the residuals. You can see the decline. You can see the skew. A lot more on the upside than on the downside because of the prior bubbles. And this shows the kind of dual log normal nature of the bubbles. We kind of have these two peaks. Okay, and then this I've separated out into the bubble zones in red, the transition zone in yellow, and the core behavior in green. And this is in gold terms. And you can see that we kind of touched the mid zone at the beginning of this year. And of course, we never got up into the bubble zone during this year relative to gold. Okay, this is something different. This is the Hurst exponent. Many people will not have heard of this, but what it does is it measures and I don't have time to show all the background and details, but it measures how trendy something is, how persistent the trend is over the long term. And normally when you determine this Hurst exponent, it's going to lie between 0 and 1. And the way it's done is by looking at what the largest range is relative to the standard deviation and then changing the window size. And you find that ratio as a function of the window size has this kind of power law exponent behavior, power law behavior with an exponent. And that exponent is this Hurst number, this Hurst exponent. And the expectation is that if you have a random walk, it's 0.5. If you have mean reversion, then it's down close to 0. And if you look at, I ran 10 years of SPY daily prices, it yielded 0.18, which is close to strong mean reversion, as people already know about SPY and stock prices in general. Bitcoin doesn't have that. It has very strong trending behavior with values around 0.7 for the weekly data and 0.96 for the daily data, using over 5,000 points for gold. And the same is true for dollar. So the gold values are shown in gold, the dollar values are shown in green. And trending considered to start at 0.75. We're really close. It's quite a strong trend.
Yeah, and the conclusion, when you say trending, I'm thinking of SPY also has a trend. It's exponential like gold. But what should we conclude when you say that Bitcoin has a higher trending?
Yeah. So what we do is we detrend the series. And for SPY, we detrend it with this long-term exponential trend. And so this is showing how the residuals behave for SPY relative to its long-term exponential trend. And this is showing how the residuals for Bitcoin behave relative to the underlying power law.
But with SPY, it does not have this characteristic versus its underlying exponential trend.
That's right. It's mean reverting. So Bitcoin has very strong trend persistence. And you kind of know that from looking at this. Once you shift from the core region, you go through the intermediate region very quickly, and then you get up into the bubble region. And it's, and the same is true on the downside. You move back through quite quickly and then back to the core.
So does it mean the core? But when you say core, it's a lower quantile than the actual OLS, right? I mean,
Yeah. Basically, for this one, I divided it at 40 and 60, and then there's an intermediate 20%. Mm-hmm. Or you can just divide it 50. Actually, it works fine, and have 2 zones. But this one, I had 3 zones. Okay, let's get into the Kelly criterion. And that is trying to look for optimal log wealth. And so the question I'm asking is, and you can ask this question, I've got Saylor's picture. You can ask this question relative to Master versus Bitcoin as well, but I'm not going into that here. Just Bitcoin versus gold. But I just want to show this comparison between what is minted, what is mined, and what is printed. So gold is mined, Bitcoin is not mined, it's minted. The mining happens when you build out the electric grid, right? They've got to do some mining or some blasting to build the dam, if it's hydropower, or if they're using natural gas, they've got to go below the Earth's surface. But we don't worry about that side of it too much. We just try to co-locate with them. And so we mint, above ground. Gold has to mine. SPY has to print. Fiat has to print. Master is both minted and printed, right? And then gold, if you look at the ETFs, those are printed. Okay. And then what is capped, what is slow, what is fast? Another good thing to ask. But this looks at, in order to look at the Kelly criterion, which was developed at Bell Labs by John Kelly, who was an associate of Shannon, who developed the theory for information entropy, and he took that and adapted it to gambling and investments. And it's very important that you consider what your time period is. how many throws of the dice? Is it once every month, once every quarter, once every year? So first, let's look at the annual. So this is just 10 years of annual. It's a chart originally, I think, from Fidelity. This one comes from Intel Core, but it shows that Bitcoin was the top returning major asset category for 8 out of the 10 years. And of course, it was the bottom one for 2 of those years because it's the most volatile. But there are 16 different categories here. It turns out that half of them are debt. And for the next slide, I throw those away because their returns aren't very large. So we look at the more interesting ones, which are Bitcoin, broad tech, small caps, and large caps not being all that different from broad tech, real estate, gold, commodities, international equities. And because Bitcoin's power law, and we know that the really highest returns are in the past, I looked at Bitcoin 5 years only. So the way this works, and I don't have time for the derivation, but the result is that if you want to grow the log of your wealth as a utility function in the most optimal way, the Kelly criterion says that it just depends on really 2 numbers. And F is the fraction that you allocate if you just got 2 assets and you're going back and forth, say between Bitcoin and dollars for this chart and broad tech and dollars for this chart. F equals P minus Q over B. Well, P is the probability that you won. So Bitcoin won 80% of the time. It had 88 winners and 10 losers on that previous chart. Q is just 1 minus P, actually. It's just the percentage of loss. So that's not a separate parameter. B is your advantage. It's your win-loss ratio. It's the average win relative to the loss. There's a minus sign here because the losses are negative. It turns out over the 10 years, 2015 to 2024, that Bitcoin's average win was 292%. Its average loss was 70%. So the ratio of those two is 4.2. And so if you calculate with this formula, you get 0.8 minus 0.2 divided by B, which is 4.2, and you end up with 75% as the fraction you would want to allocate into Bitcoin relative to the dollar, since this previous grid was all based on dollar terms. Now you can correct for a risk-free rate. If you use 4% for Bitcoin, the answer is still 0.75. Broad tech, 0.66 at 180% of the time. Its wins and losses were much smaller. Its B ratio was 1.5. You correct for 4%, it drops to 0.61. If we go to small caps, it starts out 0.26, but once you correct for the risk-free rate, it goes negative. Gold, you would say 0.36. Its wins and losses are much smaller. It won 60% of the time. Its B factor, its edge is 1.66. And so it ends up 0.36. But if you look at the risk-free rate and subtract that from all the returns, so the maximum return is not really 13%, it's 9%. Then you end up with 0.09. And a couple of other categories went negative when you did that. And Bitcoin 5 years, though, did not suffer. It was a little bit lower, but it still ended up with a 70% allocation. And if you were to look at 3 assets, if you wanted to say a portfolio that had Bitcoin, broad tech, and gold, and then you weighted those F values, then you'd have 52% in Bitcoin, 42% broad tech, and 6% in gold.
Yep.
Now you can look at how these Kelly fractions developed over time, because that's for a 10-year period. But this looks at pretty much the full history, and it's only backwards looking. So it's saying if you're sitting in 2014, or what would you allocate? And the blue line is with quarterly data, and the orange line is with annual data. And this assumes rebalancing, right? That you're changing your portfolio fraction as you go along. Um, so what you see is that with the quarterly, it shoots up to 100%. It drops all the way down to 30%, and then climbs back up, and has these kind of waves, but it settles in more or less, and it ends up by now at 51%. So if you're going to look at quarterly data, you would allocate at most 51% to Bitcoin of your liquid portfolio. But if you use annual windows, it would be 75% currently. And, it moved around, but it always stayed higher than the quarterly line, and has been in that kind of 0.7, 0.8 range for most of the past 10 years.
So that's quite a discrepancy.
It's quite a discrepancy. And if you went to monthly, it'd be down around 30%. So the point is that if you use long time periods, your probability goes up, right? And so the probability goes up, and the chance that you have a B greater than 1 goes up, right? So both terms work for you. One edge is the probability of winning, and the other edge is the ratio of wins to losses. Now, if you exceed this, then the Kelly criteria says that your risk of ruin goes up. This is optimal. There's a risk curve, and your log wealth grows faster and faster. But then as you approach this, say 0.75, but then as you go above that, it starts declining. And you can even get into a wipeout situation. Now, I would say that if you took 4-year periods, you'd always be at 100%, right?
Yeah.
Because every 4-year period has been winning. The problem with that is we only have 4 independent 4-year periods. And so we don't have good statistics on those. We have okay statistics on the 1-year periods. This is the equity curve. And what's interesting about this is if you rebalanced, despite what the last stuff showed, which is it says you should rebalance and change your proportion, you would kind of get whipsawed. So if you rebalance, say, over the past 8 years, and you started with $1,000, you'd grow to 29,000. But if you just hodled, you'd grow to 78,000. But of course, you'd have much bigger variation.
Yeah.
And we know that because, every 4-year period has been a winning period. And this is, again, just between Bitcoin and gold, not between Bitcoin and dollars, but I converted at the end to dollars. Now, this is a completely different method of portfolio optimization, and it's more like when you use Sharpe ratios. So it uses, traditional variance or volatility measure, but it also adds skew and kurtosis. It's called MVSK. And when you use it, the methodology is you put weights on the skew and the kurtosis term. How much do you want to weight them? Now, Bitcoin does have, positive skew. And so if you put weights of 1 and 1, which are these lambda and beta, then you get into that sort of mid-green area. It says 58%. And this is in a 3-asset portfolio that includes gold and SPY. So in that 3-asset portfolio with stocks and gold, you'd put 58% still into Bitcoin. And if you wanted to weight the skew, which is the lambda on the y-axis, higher, then you'd put more in.
And this one's based on 8 years?
This was based on 8 years of daily data, yes. And that underweights, Bitcoin would have higher weights if you went back longer, right? Because its return was so very high during the first 8 years. Now, that's why I restricted it some.
Mm-hmm.
So I think that the message here is one from Warren Buffett: diversification is protection against ignorance. If you know what you're doing, you can have a high allocation of Bitcoin, 50, 75%. You can go higher with some of these other techniques. The Kelly that I showed is the gambler's Kelly, which allows for risk of total ruin, and we know we never get total ruin. We have some volatility that we like to measure in terms of log price. Or diversification is Wall Street's way of saying, give us your money and we'll have the yachts. Okay, a little bit on Bitcoin versus dollar. Now here, I want to show you how the power law index itself has changed versus time. If you went all the way back to 2012, when Bitcoin was age 3, what would you have measured for the slope of the power law? And so this blue line, we've got the traditional log linear chart with the data is the orange line, and I've just used monthly data here, and the red is the best fit power law curve. But the blue line is the power law index that you would measure at that time, only looking backwards. So it shot up from 3 to over 6 early on, and it fell back down to 4. By 2015, it rose back up to 6. But since then, it's been locked in. It's been between 6 and 5 the whole time. And this one uses block monthly data. So it's a little bit lower. It's like a 5.4, similar to the gold fit. The green line shows the uncertainty in the power law, the standard error and the slope. And that starts out at 1, and it drops to be very, very small by now. And the lower chart is using Sornet's log periodic power law that you fit to bubbles, but it's not applying it to the price. It's applying it to the power law slope itself. And, I've actually got 3 different fits in here. And you see that the power law index itself adhered to the log periodic power law method of trying to fit bubbles. Even long term, it sort of, intermediate term, it kind of works for those. And then you see that by 2023, it went away. So one of the things that was happening was that the big bubbles that we saw were helping the power law to lock in a way. They were an annealing process for the power law, or the power law was kind of uncertain. It was trying to find, where it was going to settle in. And it settled and got locked in about 10 years ago, more or less.
Yeah, 2016 for sure.
Yep. And we're coming fast on to 2016. So this is OLS quantile regression in dollar terms. This was run back in May. And, back then the OLS trend price was 96K and the quantile was 87. And the projection for next May was 135 or 124, respectively. And again, you see how everything's tightened up, how the quantile regression lines tighten up, and we've been hugging the power law trends more and more, and the ordinary squares and the quantile regression median have gotten closer and closer to each other. This just shows how the tops came down. That's using the quantile regression. Now, this is showing the division between the sort of bubble side or excursions away from the mean and the core. And for this, I just divided it. This uses quantile regression, so I just divided it the median. Took all the points above, all the points below, and then re-regressed them, and also found their log normal Gaussian style distributions. So the little chart on the left has the basically log normal distribution for the core, and the bubble, it's much more spread out. It's the red one. And then in the larger chart, I've drawn the mean. So of the residuals, the rolling 4-year mean of those, and you can see how they come down pretty steadily. And the core has been flat. So the mean of the core has been about 30% below the mean of the full data set.
And just for the
Yeah,
listener, can you describe the core again when you say the core?
yeah. So I take the quantile regression and I define all the data below the trend line, the power law trend, to be the core, and everything above to be the bubbles. And then I take the mean of all the residuals in the bubbles, and that's the red line. But it's a rolling 4-year so that we can see, how it's really behaving in the long term. And then the same thing for the core. And the core, it hasn't changed very much. It's been pretty flat. And it's come down a lot in terms of how strong the residuals are in the bubbles. So there used to be a factor of 3 above the trend line, right? And when they were a factor of 3 above the trend line, the core was at 0.7. So that was a ratio of 5 to 1. And now the ratio is like 1.6 divided by 0.7. So it's about 2 to 1.
Mm-hmm.
And this shows the volatility measured now in percentage terms and how that's come down. Again, this is a rolling 4-year of those 2 zones, the core zone in green, the bubble zone in red. And it's been flat for the core at 20%. And it's come down as a reciprocal for the bubble. And it dropped from above 100% down to about 40%. And, they look like they're converging at some time out in the future.
And these
So we
are
still have,
standard deviations, right?
these are percentages. But but yes, they are standard volatility.
So 2/3 of the time
numbers. Yeah, these are variances derived from the variances standard. This actually is the 4-year standard deviation expressed in percentage terms, annualized. This shows the same thing. Basically, it's got one fit is a reciprocal fit, the other is a power law fit. If you do a power law fit, it's 1 over t to the 0.83, so it's close to reciprocal. You can't really distinguish between the two. You can even show it just looking at the 4 epochs, and that's the lower one. It just takes the 4 different epochs between halvings, and you can see it has that same sort of power law nature to it, or close to a reciprocal. And this shows the bubble behavior using again a quantile regression. I set here the threshold. Well, I looked at thresholds of 0.1 up to 0.3. The 0.2 was kind of sensible because that's where we are in standard deviation terms. And you see these little triangles that kind of measure the amount of energy in each of those bubbles. And you see the 4 big ones above, and you see a lot of little ones below and a few little ones above later on. And so if you subtract out the trend, you get the lower chart, which only shows the residuals. And so you can see better how those bubbles are behaving. And the triangles are only relative to above the threshold of 0.2. And there's been nothing. Nothing since, nothing since mid-22, right?
Yep.
Yeah.
Does that mean there's stored energy and we could explode at some point, or no? Based on your other findings.
Yeah, I don't think so. No, I don't think so.
Yeah.
I mean, right now I have to assume that they continue to fall as this reciprocal, and that's consistent with the power law because the size of the bubble should be the first derivative of the power law. Right? So the delta P over P is just, right? Should be like 1 over T, K over T, just like the return is a derivative. Now, this was an attempt to fit the waves or the bubbles that I did back in July. And this is not the same power law, but it has, unfortunately, a similar name. It's called the log periodic power law. from Sornet, who started out as a geophysicist, but later applied this to other things. And, you can apply it to certain things in biology, but he's applied it to financial series. He's written papers on Bitcoin as well. This is 2 years of data, or just under 2 years. Actually, it was about, I think didn't show it all in the chart, but I think I had full 2 years of data here. But I ran this in July, at the beginning of July. And I showed this at one of the Physics of Bitcoin shows on July 5th, I think. And there's 7 different parameters with this thing. So it's a little bit tricky to work with and sensitive. But the general idea is that you have these waves, and the waves get closer and closer. And they do that in logarithmic time relative to when they blow up. So it kind of looks backwards from it tries to figure out a future crash date, which it calls the critical time. And the waves are getting closer and closer. So how you can think about this is, you can see this first wave and the second one and the third one. You expect that the ratio between the time is a constant ratio. So if the time between the first one and the second peak was from March to January, which is 9 months, and then from the next one was from January into May, which is a little over 4 months, then you say that they're basically cutting in half each time. So the one after would be about 2 months. And you could see it goes from early May into early July. So that's what the waves look like. They're periodic in the logarithm of the time remaining until the critical point. But it takes 7 parameters for all this thing. It's a little tricky. But the R squared was pretty good. It's 0.9. And this omega is this parameter. It's this log frequency. And if the omega is larger, then you expect more waves. And 8 is kind of a moderate one. And it shows 1, 2, 3, 4, 5, 6, and later might have 7. But the key thing is it predicts a critical time. So it predicted mid-September. And it also gives you a price. And it'll give you a price just below the critical date, because it kind of it zooms up at the end there, or it kind of goes nuts. So you have to take it a few days before. But basically a few days before, it was saying 123K mid-September. In fact, we got into early October and hit 125K. So it wasn't that far off.
Did it predict this down draw? Did you go out this far?
No, it predicts a crash. It doesn't tell you how much the crash is, but 30% is not atypical of these kind of crashes.
And how well does this thing fit further back? Like if you take longer term, did you try it?
I have. I tried to do these very long-term ones. They don't work very well. It's really meant for shorter to intermediate terms. And it can get quite screwy on the short term. So I found that it works best for kind of 1-2 year time periods. And at that time, the 1 and 2 year, I would do the 1 year as well. I routinely run the 1 and 2 year, and also the 4 month and even the 1 month, and see how they compare to each other. And right now it's kind of screwy. They're all saying different things.
Interesting.
This is a recent run that I just did a couple days ago. And it says, well, I'm not giving up. It says we could keep going into January 18th of next year and hit around 139K. You've got to constantly refit with this thing. But obviously we've broken down, right? We've broken down well below the 1 sigma and below the 2 sigma here. So you have to say, well, and the way these things work is the critical date is kind of the last date you could go to, and you expect that a crash could happen sooner, but the closer you get, the more likely it is to happen. That's what Sornet says about it. So it happened, and it happened, back when the other one was roughly predicting it. If you look at the shorter term ones right now, they look very dire. They just go down, down, down. You can try to fit this to anti-crash and anti-bubble, and you can imagine that if you do a 4-month fit, that thing is just going to keep going down for a while, right? So we have to see how that will resolve. You can ask, how far behind are we right now? And in terms of time, rather than the Z value, and relative to the quantile regression, we're lagging by 7.5 months off of the power law trend, and relative to the ordinary least squares, we're lagging by 11.5 months. So that's kind of the time frame we might have to expect to get back to trend. How are we doing on time?
I'm totally good. I got time if you got time.
Good. I think we can go up to another half hour with what we have, depending on how much discussion. I just want to talk a bit about cities or companies. There's this well-known book. I encourage people to read it by Jeffrey West. It's just called Scale. And it's about finding other power laws in nature, including living organisms, but even cities. And it turns out it doesn't work for companies. And in fact, Saylor's trying to turn his company into a city with his strategy. We'll see if it works. And there's a YouTube for people that don't want to read the whole book first. Look for Why Cities Keep on Growing and Corporations Always Die, where he talks about this cities versus companies idea. And here's the work that he did with 5 co-authors, or 4 co-authors, I guess. 3 co-authors, 4 in total, 10 years ago. And they looked at 25,000 American and Canadian companies, 60 years of data, and evaluated their lifetimes. And these are log linear charts, and these are all straight lines.
Yep.
And it's a e to the minus 0.098 decay curve. And that turns out to be an average lifespan of 10.5 years for companies. And what happens? Either they go bankrupt, there's some sort of liquidation, there's a leveraged buyout, there's merger and acquisition, they acquire a bigger company or whatever, but they disappear on average after about 10 years. And, if you make it to 50 years, you're doing extremely well. And he color coded these for different industries. We've got a broad range of industries. And so you see a little bit of difference, but not too much. They all trend more or less that way. Sometimes you're able to form a monopoly. We've got 7 MAGA companies. They've got pretty well established moats. A lot of them have been around for a quarter of a century, some of them more. But those are the very rare few, right? That's 7 companies out of 25,000. Bitcoin is different because exponentials are unstable, both on the way up and on the way down, because Bitcoin's a network. And I wish I had another slide here, but it's a very rich network, just like cities are very rich networks. Cities adhere to power laws because their utility infrastructure, which includes their transportation and their roads and their water supply and their electric supply and their internet supply and their gas supply, and even their police and fire departments, there are economies of scale there. So the cost to put in that infrastructure does not grow linearly with the population. It grows as about the 0.85 power. But the GDP of cities is super linear. the artistic creativity, the number of patents issued, the GDP of cities, and yes, even the crime rate grows faster than the population. And it's about a 1.15 power law. So if you take the ratio, it's about a 1.3 power law, about a 4/3 power law advantage that cities have over small towns in the countryside in terms of how much return on investment on their infrastructure they get for their GDP and their other economic output. So Bitcoin is a meta network. There are actually many networks related to Bitcoin, right? There's the minting network, there's the full node network, there's the exchange networks, there's the now we have, the institutional capital in terms of ETFs, treasury companies, and so forth. There are about 10 different networks for Bitcoin. Certainly all the wallets that people have is another kind of network. So Bitcoin has grown and adhered to Metcalfe's law, and it's manifested a power law because the internet and communication networks and social networks behave in a Metcalfe's law type style where the value grows something like the square of the number of users. Because once you log in, you can talk to every new person that's logging in, and that's where you get this square relationship. And in practice, it can be a little bit less, but it tends to be in that 1.5 to 2 range.
Yeah, and
So
I think,
Bitcoin, yeah,
sorry, just to interrupt. I think
no, go.
I've talked about this as well over my summer tour that I gave here in Europe, but it's really is interesting to think that I think Wes put this in his book as well, like the growth of cities. We don't just sort of explode exponentially into the sun. We used to grow faster. The major cities a couple hundred years ago, now they grow slower as far as population goes. And
Mhm.
Bitcoin is similar to that. It's growing a little bit slower each year, which is more like a city compared to, other exponential assets.
Right. And new cities get created, right? I mean, there are a lot of new cities in China, and cities pass these kind of when they get to the scale of like 10,000 and then get to 100,000, that's when they start behaving in this fashion. Um, so they have different distribution lifetimes, and they kind of have to get to a critical level to be sustaining for a long time, and then they can last centuries and even millennia. Now, it turns out there are only 7 cities with a larger GDP than Bitcoin. And I define GDP for this context as annual market cap value increase, which is about 40% on trend. For a $2 trillion asset, it's about 800 billion is the capital growth. And so if you compare that to cities' GDP, there are only 7 that are larger: New York, Tokyo, LA, San Francisco Bay Area with the Silicon Valley, Seoul, Paris, and Chicago. And it's a meta network of power laws. We've found that the hash rate grows as a power law, the price grows as a power law, the number of addresses grows as a power law. I should put this question to ChatGPT-5, but when I put it to 4.0, while Bitcoin isn't a megalopolis in a literal sense, the metaphor works well to describe the vast, interconnected, and influential digital ecosystem. And I note that Bitcoin is perhaps the most valuable software code ever. Certainly line for line it is. Windows and Office have had $2 trillion in revenue over 3 decades. Google and Search had $2 trillion revenue over 2.5 decades. Bitcoin, $2 trillion market cap over 1.6 decades. And that was with one application, very small code base, right? Now you could argue too, maybe, Lightning hasn't really changed the market cap, but one code that everybody runs, the most valuable software code ever. And we're just putting out this week from OrionX, where I'm a partner and analyst. We're putting out our 15th semi-annual crypto super report. I've been doing this for 7 years now. And we do it twice a year because there are two big supercomputer conferences that happen every year, one in the US and one in Germany, which is the big European conference. The one in the US is just wrapping up. It was in St. Louis this time. And the fastest supercomputer in the world is at the Department of Energy, and it's used for science, but really for nuclear security mission. You simulate nuclear weapons so that you don't have to actually explode them, in the desert in Nevada. And it performs at 1.74 exaflops, which are 10 to the 18th floating point operations per second. And there are only 4 supercomputers in the world that exceed an exaflop. It takes 87 cabinets, 35 megawatts, costs 600 million. Its value could be considered priceless. And they publish a list of the 500 largest supercomputers in the world. And if you aggregate them all, it's something that's basically an order of magnitude than the faster machine, but it's not hugely greater. And the aggregate number of chips would be hundreds of millions of cores. And, a wide range of science, engineering, and AI applications. Now, you can't directly compare the Bitcoin network because it's doing hashing, right? But you could take El Capitan supercomputer and it'd be exceedingly slow for hashing because the ASICs are so well designed and special purpose.
Yeah.
And they actually have thousands of functional units in them. They have many, many cores. I took one typical kind of machine, which is the WhatsMiner 63S. It comes 12 to a cabinet. You would need 234,000 cabinets or about 3 million of the nodes, ASIC nodes there. Your power consumption would be 21 gigawatts. If you had this sort of uniform network all working on Bitcoin, and in reality, it's estimated to be around 26 gigawatts rather than 21. So it's roughly comparable. And the investment would be 23 billion if these were the machines you bought. You'd put out 164,000 Bitcoin per year with a value of around 15 billion per year. So it's kind of interesting to see how the capital cost compares to the annual production as well.
Yeah, I'd be curious about that calculation with all the expenses of electricity and everything else.
Yeah, this is only the capital cost. It doesn't show the electricity cost. So if you assume that your electricity cost is half and you had 8 billion, then you have to amortize that 23 billion, right?
Yeah.
So that would be a 3-year life kind of a thing. Yeah. Which is not too far off, the idea of a 3-year life.
Yep.
But again, we've got a broad distribution of equipment. This is assuming, a monolithic kind of equipment calculation. I happen to have the price available for that one, so it's convenient. Okay. Why am I going the wrong way? All right. Let's go back here. Okay. Let's close with some cosmology and then with some Bitcoin's war on fiat. But this kind of sets the stage. So my background is originally in astrophysics and did some cosmology work. And, the two big questions that we're facing are the nature of dark matter and some of the details around dark energy. When I was in graduate school, we kind of set dark energy to the side. It didn't really get discovered until 1998. But dark matter has been known about since the 1930s when Fritz Zwicky analyzed the Comer cluster and the random velocities of galaxies and found that they were 2.5 times greater than what's expected. And so that meant you have to take the square of that. So you needed a lot more matter. He was a little bit off in his calibration. There have been a lot of studies in the 70s by Rubin and Ford around rotation curves of galaxies. That is, they're moving a lot faster on the edges than we would have expected based on how their light falls off toward the edge. And so by now we have a good measure of dark matter. There's 5 times as much as there is in all the ordinary baryonic matter, which is just protons, neutrons, and electrons that, stars and planets are made up of. So this pie chart shows 5% normal matter as the contributions to the overall mass energy distribution of the universe, and 26% for dark matter. But the biggest piece is dark energy. Now, it turns out that when you go into the past, that was not the case. And the reason is that normal matter and dark matter thin out with the expansion. And we know from the cosmic microwave background, which reflects the conditions of the universe when it was only 380,000 years old, that it was 1 billion times denser than it is now. That is, each linear dimension was 1,000 times smaller, and the cube of that was 1 billion times denser. And at that time, dark energy was not important at all, because dark energy has a constant value, even in a vacuum, for all elements of space, all cubic meters or cubic centimeters. They have the same value. So as the universe expands and new space is created, dark energy is kind of this free lunch, although it is part of gravity. It's doing work against gravity, and gravitational potential has negative signs, so you can actually conserve energy with this. But the normal matter and the dark matter both thin out with the volume, which is 1 over r cubed, as the radius of the universe increases. And so at one time, they completely dominated. Dark energy wasn't there. And right now, we're kind of in that situation with Bitcoin. We're not the dominant component. So I identify normal matter with gold, dark matter with fiat. And the idea is that, it's pervasive, but it's not quite real. It's not a real commodity. It's just a ledger. You see its effects. It's mostly digits and central bank balance sheets, but it's actually a stabilizing framework for our current financial system and for our economies. But what happens is, as the universe aged, and its current age is just under 14 billion years, as it got to about 9 billion years of age, as these things thinned out, the constant value of dark energy, which is 4 giga-electron volts per cubic meter, dominates, and it's been dominating more and more. So it was at the sort of 50% level if you go back 5 billion years. And since then, it's grown as a percentage, and it's now grown to be 69% of the average mass energy density universe. And that is very little, actually. It's very thin. It's only the equivalent of something like 6 proton rest masses per cubic meter. And of that, we're saying that 4 proton rest mass equivalent is dark energy, and 2 is the dark matter and a little bit of normal matter. So as the universe expands, this becomes more and more dominant. And so Bitcoin wants to play that role. It wants to do what dark energy has done and eventually overcome the normal matter, which is gold, and then eventually the dark matter, which is fiat in this analogy. And it's interesting that the ratio of fiat, if you use M2 relative to gold market cap, is also about 5-to-1. It's similar to this dark matter, normal matter ratio. Okay, so how does this project out? So we know with the power law that the expected annual return is decreasing, but it's still very high. It's about 40%, 39% right now. And so this is a chart that's showing the expected growth of Bitcoin's market cap from, 2 trillion now into the future, out, the next quarter century. And then in comparison to the US M2 money supply, which is 22 trillion now, 11 times larger now, but it's grown forever, basically doubling every decade, about 7% on average. So if you project that exponential forward, 7% compounded annual growth, they will cross at 50 trillion in the year 2036. How does this compare with the base money, Matthew?
Base money will, well, my calculations are slightly different, but I got about 2041. So it's
For
that's a
global
global
base
figure.
money?
Yeah, you're using
Yeah,
US M2.
yeah. So I'll show the global on the next slide, but with M2. Okay, this is kind of the inverse chart. So first look at the upper right. It's the broad money supply, which is the M2. I think there's some M3 numbers in here because it's a little messy. They say, this is from Visual Capitalists, they say it's 142 trillion globally, 22 trillion for the US, a similar number for Euro, a higher 30 plus for China, and then the rest. But they claim it's been 7.0% compound annual growth rate for the last 25 years. And that's what I used. Actually, even before I saw their chart, I used the same 7% because I'd seen that before in the China context. So the table says, how old will Bitcoin be when the target return is 25% or 20% or 15 or 10? And Bitcoin's age will be 26 or 31 or 41 or 60 years respectively. And its market cap, will grow into the hundreds of trillions over time. And global M2 will grow, but more slowly, like this 7%. So by the time the Bitcoin return drops to 15%, it will be age 41. That's the year 2050. And it will be more than half of the market cap of M2, which means it will be greater than the euro market cap, greater than the dollar market M2, and will be greater than the Chinese M2. So it will be the largest money or currency, if you will, by then, but will still be smaller than the global M2. So I calculated the M2 over Bitcoin ratio, which currently is about 60 to 1, right? Actually, I used 120 trillion. I didn't use 140 as a starting point. But it's about 60, 70 to 1, and it falls down along this curve, and it becomes 10 to 1 when Bitcoin's age 25 or 26, which is, the mid 2030s. And it exceeds, the 22 trillion of US will be up to about 50 trillion. So it breaks through that in this curve, I don't know, before 2040. And it reaches parity a little bit after 2060. And in 2060, say 2063, when it's about 53 years old, 2062, it'll be at parity. So some age around 50 years, 50 something years. And this is using the 5.82 power law of the quantile regression, which is a little bit steeper than the ordinary least squares power law. So what does it mean? I think it means decades of gradual displacement of government-driven monetary policy, governments will, over time, lose their ability to drive monetary policy. It gets transferred to Bitcoin, and Bitcoin ultimately becomes the monetary standard, presumably displacing the US dollar, because I don't think there's room for either the euro or the Chinese yuan to step in. What's your view on this?
Largely sympathetic and agree to most all that you're saying. I think around the edges there might be some differences on the numbers, but it doesn't really matter. But and I mentioned to you pre-show, it's something I've been talking about a lot on my stream. I think it's the sort of $1 trillion question. Is I'm trying to figure out, as you talked about at the top of the show, it's very rare that a financial asset will grow in power. And before we get to talking about a Bitcoin standard in Satoshis, that's even like a little bit more confusing for people. But if you still consider we have fiat currencies that governments like to print, it's very difficult for me to envision how credit would look in that world, right? And the simple example you could use is Saylor himself, right? So he's paying 10% in interest on most of his instruments. And Bitcoin won't hit a 10% growth rate until 2070. So we're a little bit outside of the time that you said. So it's very theoretical, but I do wonder, there will come a time where, at least in the world that we know today, Bitcoin is growing slower than some of these fiat growth rates. And that's what I'm trying to figure out. It's more philosophical, I think, really, at the end of the day. But I'm curious what you think about that world.
Yeah, I mean, I don't know. It's very hard to predict this world of the future here because it is far out in multiple aspects. But we've got some companies. We've got a few companies that grow in above 15%, and I mean, NVIDIA for a decade has grown at 68, 69%, right?
Yeah.
That's pretty unique. I've demonstrated it cannot do that another decade because it would end up being half of global wealth. So that's not going to happen. But I think what happens is that, there's this expression, Bitcoin is the hurdle rate, right? So the hurdle rate is coming down. And certainly there will be companies that want to grow at 10 or 15%. We're going to have this period of time when at least the largest countries, strongest economies will be able to maintain their currencies. I think the smaller countries will have to, decide sooner, right? They'll either have to enter the euro or some similar combination that's larger scale, or they'll have to adopt Bitcoin. And there are different ways to adopt Bitcoin. One could just say, I'm going to establish a currency board, and I will just hitch my wagon to Bitcoin. I think in order to do that successfully, they're going to need to add some Bitcoin to their reserves. And so then it becomes a question of what reserve level do you need? And if we go and look back at the history of the gold standard, you kind of needed 20 to 40%, right? Something like that, in order to maintain the standard. So I think we'll see these kind of transitional moves where the smart ones will issue fiat bonds to acquire. Every fiat bond that you issue to purchase Bitcoin and put that into your treasury to back your currency, right, should be in profit over 2 or 3 years. And, you'll strengthen your currency by issuing more debt, actually, as long as you don't spend that proceeds and just put it into your treasury, right?
Right. Do you see a world where we continue to have these fiat instruments, the big powerhouse governments, which have a lot of, guns and nukes, They want some sort of a control. So maybe due to their control and the whatever proportion amount of Bitcoin that they may have, it's possible that the curve of Bitcoin in which is a power law right now, might turn into an exponential and go compound to some instrument that, or to some rate or ratio that the big governments want to borrow at. Do you see that as a possibility?
Well, I imagine that some governments will try to engage in a race with Bitcoin. They'll say, oh, Bitcoin's market cap is growing. I can't allow their market cap to catch up to my money supply. So what will they do? They'll inflate at a higher rate, probably. But it all becomes a kind of game theoretical thing
Mm-hmm.
as to, how different governments react and whether they also follow in turn. I think the long-term effect is that it's going to constrain them more and more. I'm reading Saifedean's latest book. Have you looked at it at all?
I have not. No, the
The
gold standard.
Gold Standard, and it's part history and part fiction. And the first few chapters are history. I've been through those, and I'm just starting into the fictional history. And so what he does is he kind of goes up to World War One, and then after that, he imagines a different future from the time of World War One. And he's got some Easter eggs about Bitcoin in there about how could you have a gold standard that would have lasted longer. So I don't want to give away the plot, but if you had tried to stay on a gold standard, and he's got a device to do that, and some cute things around that in this, fictional history, then that would put more constraints on government's ability for deficit spending for war or for other purposes. Obviously, as long as you're on that standard, right? Because it's once it broke in 34 and 71 that things really went exponential. So I don't see exponential runaway from Bitcoin. I'm not saying it can't happen. I'm more of the mind of we have to monitor it to see if it continues to stay at a high power law or flattens somewhat. And the flattening would happen if the adoption flattened. But right now, I think we have the adoption driver because between the ETFs and the Treasury company and the sovereign wealth fund here and there and the government here and there, the institutional holdings have been growing as the fourth power of Bitcoin's age. So people were worried that wallet growth was flattening out. And I dismiss that because what's happening is the wallets are getting fatter because the wallets are now owned by ETFs and treasury companies. And you look at those balances, which are now up to 4 million Bitcoin. But if you look at them for the past, more than 5 years, really going back about 7 years, they've been growing as the fourth power of not time since then, but time since, Bitcoin was created, Bitcoin's age.
Mm-hmm.
So that allows us to stay on this steep power law curve.
Yeah. I'm curious. I'm curious the relationship and wondering what you think about this because I like reading a lot about gold history too, and the European influence on gold, and as you know, and I'm sure Saifedean writes about it. It wasn't that long, really. The classical
Right.
gold standard, right, started in
Right.
1870,
Right.
and my view is actually whatever. Well, there's two things. First of all, politicians are always going to promise the easy way out, right? And so they get that with basically depegging anytime there's either a war or a crisis, and so that happened as well during World War One. But the real nail in the coffin of any sort of a decentralized model for gold, in my view, actually wasn't because of FDR or anything else. It's because of Hitler and Stalin. Because their terrorism of Europe, basically 80% of the world's gold by the first year of World War II ended up in the United States just because it
Right.
was fleeing for safety.
Right.
And that, to me, that centralization risk, of course, it set up, the American era and all that, but that's not really, in my view, uh, the focal point. The focal point is, would that happen with Bitcoin? That's sort of an idea.
Hmm.
And I think Bitcoin is robust enough that it doesn't happen,
Right.
but I'm not, and I hope that doesn't happen. But I'm curious,
Gold
right?
gold wants to be centralized because it's so heavy.
Yeah,
Right.
right. Back to your matter argument.
Yeah. So the I calculated the weight ratio just thinking about what does it take, how much gold do you need to hold the value of Bitcoin? And what do all the full nodes weigh? And the gold
Mm,
is tens of thousands of tons, and the full nodes weigh, 50 tons. All the full nodes in the world or something. I don't know. I mean, you can add in the mining equipment too, but really, all of the value is stored in the electrons, right?
yeah,
Inside the cells in the SSDs and the full nodes. And they move at no cost across the globe. And this was the big problem with gold. You couldn't ship it around. It was hard to divide and hard to assay.
yep.
And so it wanted to be centralized in vaults and have certificates issued against it. It doesn't mean we don't have Bitcoin certificates, but it's conquered space and time.
Yeah, I think it's going to be this tension, exactly what you just said. It doesn't mean that we won't not have Bitcoin certificates, i.e., we will.
Yeah.
But I wonder how much that could run away. Because if that runs away with it and people actually trust it and believe it, then I think you're back to an exponential
Right.
world. So that's, I think, the tension. I'm curious how far you think your model, your analogy of dark energy can run. It's very interesting. Uh, that's a very interesting way to describe, the phenomenon of Bitcoin in the
Well,
universe.
if you applied it to the current ratios, we're in a universe that's only 2 billion years old in the analogy, which is only 1/7 of the way in age terms of, right? So that's our situation with the analog of Bitcoin as dark energy is when the universe was 7 times younger than it is now, which is the part that we're looking at with the JWST, James Webb Space Telescope. We're looking at the first billion years roughly and seeing the galaxy formation and so forth,
Right.
earliest galaxies. So it's early days. I think the lindiness and the Hurst exponent and the flattening of the slope tell us that we've gone 17 years, that the next 17 years look pretty promising. The next double of age looks pretty promising. And I don't think we'll know if the power law is broken until at least half that time's gone by. You're going to get it 10 times. It's very interesting. With this power law, 10 times is exactly equal pretty much to half the current age. So if you're age 17, then in 8.5 years, you'll be 10 times. And once you're, age 20, then you have to wait 10 years for the next 10 times.
And the fit is pretty good. What other risks do you see to the power law becoming
Risk to the
invalidated?
power law or to Bitcoin?
Bitcoin fitting the power law, let's say.
Well, saturation. I mean, the internet's saturated, but Bitcoin's a long way from saturation. It's very early in internet years, as we know. The internet followed a power law until about 2005. It started flattening. It's saturated. Now everybody's on the internet, and you can't add people, but we're going to be adding AI. We're going to be adding bots, and we are adding bots using the internet. And the same thing is going to happen big time for Bitcoin, because Bitcoin is the natural currency for bots, right?
Yeah.
It's hard for them to have credit cards. It's hard for them to have bank accounts, but somebody can give them a SATS allowance. And they need to go out and purchase data, and they need to purchase services. And so they're going to be monetized. It's already starting to happen. So I think this prevents the user count from flattening out, because the number of bots does not have a constraint of 8 billion. One other interesting comment, speaking of 8 billion, Bitcoin is designed for our future towards the end of the century, because the population is going to peak at around 10 billion. And it's probably going to do that around the middle of the second half of the century, around, say, 2075, 2080, depending on what projections you look at. And by then, Bitcoin, will have the dominant value component, market cap, and it'll have, a finite supply. So finite supply of Bitcoin, dropping population, economy not growing necessarily exponentially. We don't know. We don't know how AI is going to affect everything. But if the population is dropping faster than 3%, are we really going to be in a growth economy? So you'll have per person money supply will be expanding from 2075 on per capita. Now we'll be fighting with the bots for it, but
Interesting. The talk of population made me think of also back to the cities, right? So the cities grow like Bitcoin with that declining growth rate. Population worldwide is also declining at the moment, but it's still on a long enough time scale. It's exponential, right? So it's different. Just like global GDP is exponential. Is there anything there in what you just said? Like, could global population also change into a power law, or is that too far out there?
no, I don't think there's any. I don't know if there's a power law tail in the distribution somewhere. It's going to grow, peak, and fall, and it's going to probably fall like an exponential. I mean, it is a decay. It is a growth and decay kind of process.
Right.
And we used to have really high growth rates, and they're getting slower and slower, and then we go into that peak. What's the number one factor? Moving into cities actually is the number one factor. It's when you move into cities that you fall well below the replacement rate. And that's been the big trend. Everybody's been moving into cities and increasing numbers of cities.
Yeah. What about the relationship back to technology? A lot of people say it's not going to be a power law. It's going to be an S curve of technological adoption. Do you have an opinion on that?
Yeah, it's not a logistic curve.
Right.
We've repeatedly run logistic curve against it. It just doesn't fit. Doesn't fit the data.
Yeah. And conceptually, no, go ahead.
Well, I've looked for flattening and haven't seen it. There is a model called the Weibull cumulative distribution function. It has 3 parameters instead of 2. So with power law, we just have 2 parameters, right? The power law index, the slope, and then some leading constant to kind of normalize the curve. With this, it's sometimes called an S curve, the Weibull, but it's not like the logistics curve at all. And in fact, the way it grows is it's in a power law. It grows as a power law until it reaches some critical level, and then it flattens out and it saturates. So if you were to say, Bitcoin's on a path to some ultimate market cap, maybe in gold terms, um, it would grow as a power law, and then the power law would get flatter and flatter, and then it would saturate. And I've run those models, and they don't fit any better. The one that fits best amongst those is the one that has, saturation out at 300 trillion or something. The power laws model, the pure power law model, fits better. But I'll continue to monitor to see if something happens.
Yeah. And conceptually, I've always heard, I don't know what you think about this, but you see those charts. I could put it up. People can easily Google it or ChatGPT, like all of the things like, the washing machine, the telephone, inventions, a lot in the US in the 1950s and 60s. They follow that S curve up and then they flatten out. But those, usually all of them are technologies that are dominated by a few companies and their products, and networks arguably don't do that. Again, explaining that, I'm not really sure. I don't know if you have any thoughts on that.
No, that's the distinction, is that they are products. They can have kind of faddish adoption. They get a lot of advertising behind them and push, and they tend to come from a few companies. Model T, Ford, the radio, the telephone,
refrigerators,
yeah. But the internet is a network. Social media are networks. Now, it's true we've got some kind of monopoly stuff going on in social media for different sections of it, but the internet as a whole, it's not like one company was driving all of that. It was a whole ecosystem of companies. It was more like a global city of companies in a way, but certainly network effects were going on, and that's what's happening with Bitcoin. And so the reason why networks end up as power laws is that you have preferential attachment to larger nodes. And for Bitcoin, the larger nodes were the exchanges initially. And now they're the ETFs and the treasury companies, or, even governments, to the extent that a government is buying for its citizenry, or we've got pension funds, we've got sovereign wealth funds, we've got universities. So everyone who has, a share in a pension fund is already automatically preferentially attaching to that fat node, and they don't even know it. They don't even know what that node holds Bitcoin, right?
Right.
But then that causes this kind of power law, and the actual slope you get, I don't know. It kind of comes about as it sort of finds its minimum energy or something,
Right.
way to grow.
We're getting close to 2 hours, Stephen. How you doing on time?
Yeah, probably good time to wrap.
Okay. Can I ask you one more question?
Absolutely.
Because I'm curious. It's still back to the debt, still back to the interest. It's a tough one in my view still. But we have this, Jeffrey West, who you mentioned in Scale, he has this, and I did the presentation on this as well. Like, we may not understand it, we may not feel it, but for sure, it's certainly the best time to be alive. We're growing faster and faster. And even if you can say we have compound exponential growth, which is, a flat line, the interest rate, or the curve is a flat line like this on log scale, the value curve, log linear. We still, over, shorter and shorter epochs, we get faster and faster. Like in the 1800s, the stock market was only growing, 2%. Then the early 1900s, it was faster, 7, 8. Now it's like 11, 12%. So it is getting faster. And he calls that super exponential growth. Right. So faster and faster exponential. And I'm still trying to draw. And so that is in my view, the game of inflation too. Like inflation obviously is a very negative connotation thing for us in Bitcoin and for good reason. But even if we wanted to strip away all these loans and credit and everything, that would be so detrimental to the system. It might not be worth it, right? I mean, we just said you have more and more credit, more and more growth, and we're just moving faster and faster and faster. And I'm just wondering, what's that? Is it just going to be some explosion at some point where we have this Bitcoin with a limited amount of Satoshis, going down on the growth rate? At some point, that super exponential growth is going to meet the down curve in fiat terms of the Bitcoin growth. I'm having a hard time putting it together. But my question would be like this: I would have a hard time lending out Satoshis at some point, because if it were on a pure Bitcoin standard, finding that exponential product or investment would seem to be very, very difficult. And that's why I'm actually theorizing about this exponential Bitcoin turning into exponential, which is very sad in many ways, and I wouldn't like to see it. But more and more fiat interest against solid Bitcoin. It's kind of a blob of words as we close it, but let me leave it with that.
Yeah, it's does this Ray Kurzweil singularity happen in the next 10, 15 years, right? Yeah. And what does AI do? Does it drive that? And how far can large language models stretch? It's certainly been helpful to my productivity.
Same.
Yeah.
Same.
Yeah. I could not imagine running these log periodic parallel models that have to search 7 parameter space. It's just it's really something.
Yeah.
I don't know. It speeds up, no doubt. Technology is speeding up. Financial techniques are speeding up, and financial engineering, and there's some very strong dislocations in the world, and I think we'll go through some interesting times.
Yeah, dislocations, I think, is that's probably the best word to possibly leave it on with what Bitcoin can do.
Mm.
Well, listen, Stephen, this was really great. I hope everybody enjoyed the presentation, and if they didn't see it or tuned in late, definitely check it out. The whole thing, it was amazing. Thank you so much. I'd love to do it again, and wish you all the best moving into the weekend here. And thanks for chatting.
Thanks, Matthew, and thank you, people who joined.
Yeah, thanks everybody. Have a great weekend, and see you next week. Take care, Stephen.
Take care.